June 15, 2006. Heavy competition for industrial/warehouse loans. Chicago, Illinois, June, 2006. The intense desire to lend on choice properties ultimately leads funding sources to industrial and warehouse properties. All types of assets in this class are sought, including bulk warehouse, storage, distribution, incubator, flex, 25% or more office space, and manufacturing buildings. Generally speaking, the most desirable properties are anchored by credit tenants. These assets are typically newer, 10 years or less, higher ceiling, 28 feet clear or more, buildings located in well-established business parks. These properties are usually in proven markets with occupancy levels in excess of 90%. Industrial loans are harder to find than some other property types. Newly constructed properties are often built to suit for owners, even more are already owner-occupied. These properties will usually be financed by owners via their business banking relationships. Finally, larger pools of industrial loans are rare, leading to smaller loans per property. Based on typical underwriting parameters, industrials capture the most favorable interest rates and dynamic terms, including the following. 1. First mortgage lien based 75 to 80% loan-to-value/purchase price. 2. 90 to 110 basis points over comparable term Treasury notes for Class A/credit properties, up to 150 basis points for partially leased, older and smaller properties, for example, less than $5 million. 3. Takeout, forward delivery, debt priced as low as 2 basis points per month, 2-year maximum. 4. Interest-only payment combined with 30-year amortization, even for older properties. 5. Bundled closing costs combine third-party reports with discounted underwriting fees. 6. Less differentiation between underwriting credit and non-credit occupied assets. 7. Additional wraparound debt reaching in excess of 85% LTV at premiums of 200 basis points or more. Even though rates have been steadily climbing, particularly short-term, floating-rate debt, long-term mortgages are very attractive in comparison to historical norms. Nats Vaslow, research director of the Real Estate Capital Institute, suggests industrials stay in favor because of tenant-driven supply restraints. The shorter construction cycle keeps spec and pre-lease development activity nearly in tandem.